One being resources. There's going to be a significant amount of investment in resources that are going to be needed for this in terms of the classifications of the liquidity buckets, implementing an ongoing monitoring program, as well as the actual reporting requirement itself coming in December of 2018 for larger funds, 2019 for smaller funds. Also, it's going to have potential implications to the actual strategy of the fund. Right? So if a fund is below its highly liquid investment minimum, it will force the buying of only highly liquid assets. Now, if they're close to have already breached the limit on illiquid investments, it's going to prohibit the potential acquisition of new assets that are illiquid. So a couple things to think about from an operational perspective, but also from a portfolio management perspective. Depending on who you ask, there's slightly different definitions of liquidity. But generally speaking, it's the ability to execute sizable transactions quickly at low cost and near or at the market price. Said in another way, limited price impact. The lack of trading activity in the name doesn't automatically equate to it being considered illiquid. This is probably best served by an example. Let's say you're sitting on a particular attractive piece of paper. If you were to put that out for bid, chances are that you would be able to execute a transaction in relatively short order, despite not having previous trade activity. That's probably a question that's just as complex as actually measuring the risk itself. But let me summarize a couple things for you. First, they're going to have to look at what we refer to as significant change in value. So they're going to have to look at a hypothetical sale of a transaction. And within there, they're going to have to estimate if they could potentially experience a price impact that's meaningful. Second, they're going to have to look at market depth. This is going to be a key input into determining the liquidity buckets for the asset class. And then finally, they're going to have to look at what's referred to as reasonable anticipation of trading. So they're going to have to look at the sizes that they are going to transact in, and then they have to assess whether those sizes could potentially impact the liquidity of the investment itself. So from a vendor's perspective, if you think about the core competency of an asset manager, right, it's generating returns for the fund's investor. Right? So they're thinking about asset allocation, credit selection, risk management. Where the vendor comes into play is we can provide mission-critical data sets, estimates, as well as workflows that could help them in their daily routines of their liquidity risk management.